Insurance companies are among the largest bond investors in the world. A major European insurer like Allianz, AXA, or Generali manages investment portfolios of hundreds of billions of euros. But how do they actually decide what to buy? In this video, I am going to walk you through the investment framework that a typical life insurance company uses to build its fixed income portfolio. From the liability profile to the asset allocation to the specific instruments used. This is what institutional fixed income looks like in practice. Everything starts with the liabilities. Before a single investment decision is made, the insurance company models its future obligations in detail. When will it need to pay claims? How much? Are the payments fixed or linked to inflation? A life insurer selling long-dated savings products knows it will face redemptions in 2035, 2040, 2045. The investment portfolio is built around those future cash flows. This is called asset liability management, ALM, and it is the foundation of every investment decision an insurer makes. The key metric is duration. If the liabilities have a duration of 14 years, the assets must also have a duration of approximately 14 years. When interest rates move, assets and liabilities move together, protecting the solvency position. Now let's look at what a typical insurance portfolio actually contains. The largest allocation, typically 60 to 70%, is investment-grade fixed income. Government bonds form the core. They provide the duration backbone and the liquidity the portfolio needs. Long-dated government bonds, 30-year French OATs, German bonds, UK gilts, are particularly valuable because their high duration matches the long-dated nature of insurance liabilities. Corporate bonds add yield, pickup, above government bonds. A well-diversified allocation across sectors, financials, utilities, telecoms, industrials, can generate 50 to 100 basis points of additional yield over comparable government bonds. Under Solvency II, investment-grade corporate bonds carry acceptable capital charges that make them attractive on a risk-adjusted basis. Covered bonds, particularly popular in Europe, offer a yield pickup over government bonds with very low credit risk and favorable Solvency II capital treatment. German Pfandbriefe, French obligations foncières, and Nordic covered bonds are common holdings. The second major allocation, typically 10 to 15%, is real assets, infrastructure debt and real estate debt. Infrastructure debt, loans to toll roads, airports, renewable energy projects, regulated utilities, offers several advantages for insurers. Long duration, that matches long-dated liabilities. Illiquidity premium of 50 to 150 basis points above comparable public bonds, and stable, predictable cash flows that are often partially inflation-linked. Under the Solvency II framework introduced in recent years, qualifying infrastructure investments benefit from favorable capital treatment, making them even more attractive for European insurers. The third allocation is private credit and private placements, typically 5 to 10%. Private credit offers higher yields than public markets for comparable credit quality. The illiquidity premium compensates for the fact that these assets cannot be easily sold. For insurers with long-time horizons who intend to hold assets to maturity and collect all cash flows, this illiquidity is not a problem. It is a feature. A small allocation, typically 5 to 8%, goes to equities and alternatives. This is the return-seeking part of the portfolio. Higher expected returns, but at the cost of high Solvency II capital charges. Every percentage point in equities consumes significant regulatory capital. Re-kondikind-seeken and enikitas intrengsi, we inapodebodo brakodanyasti, re-do debodro. which is why insurance portfolios tend to have much lower equity allocations than pension funds or asset managers. Finally, a liquidity buffer of 2 to 5% in short-dated government bonds and money market instruments. This ensures the insurer can meet unexpected claim payments, margin calls on derivative positions, and liquidity needs without being forced to sell long-dated assets at a loss. Every asset in an insurance portfolio serves a specific purpose. Government bonds for duration and liquidity, corporate bonds for yield pickup, infrastructure debt for illiquidity premium and duration, equities for return, cash for liquidity. And every decision is filtered through 4 variables simultaneously: return, duration, liquidity, and capital consumption under Solvency II or RBC. That is the complexity that makes insurance investment management one of the most demanding and rewarding disciplines in institutional finance. If you want to go deeper, how ALM works in practice, how credit spreads are analyzed, and how Bloomberg is used by insurance investment teams, subscribe to this channel, and if you want a structured learning path, check the link in the description.